Good morning, everyone. Today is Wednesday, March the 12th, a few minutes past 8 a.m. Pacific time, and I want to spend a few minutes going over a trade I made this morning in Rivn. And this morning I decided to make a small play in the April 17th expiration. So the particular strike of interest to me this morning was the 14 strike, and at the time I was looking at it, Rivn was trading for about $11.25 a share. It's gone, looks like it's gone down a bit since then. Yes, so now it's trading at $10.96. But anyway, was trading at $11.25, and the 14 strike puts were trading for roughly $2.95-ish cents. And as we can see here, they're currently at $3.15. So when I was interested in this, the other side of the ledger, the 14 call, same expiration, April 17th, was roughly 23 cents. So there was about a little less than a quarter in time value for this 14 put. So to me, that meant that if I was getting a decent price, it was going to be around 14 minus the difference, minus the difference of the underlying, which was 11.25. So there's 275, and the premium, the time value on this 14 put was roughly 23 cents. So if I could get something around 295 at the time, it would have been a decent price for me to pay for this put. I ended up getting 293, which was good. And then what I wanted to do, or what I ended up doing, was buying shares of Rivn. I bought one put contract. So I was looking to pick up 100 shares of Rivn, but I didn't want to pay the price at the time of $11.25. I needed a lower price. So I waited a little bit, and fortunately I got lucky and it worked out. But what ended up the final position, buying the put, buying 100 shares of stock, leaves me long, synthetically, a call from the 14 strike. And that's what I quickly want to go over. So here's a setup of what I did. I usually use these payoff strategy calculators for some different options positions, so in this case I made a minor modification because I have some stock. But anyway, we'll see here the position, call or put, and I can add in stock there. Strike price, the initial price, and then I have underlying set up for calculations. So anyway, at the 14 strike, I paid $2.93 for it. And what that looks like, if I isolate just that put, it's the following. So if we take a look at this risk payoff, this is for the put. So it's at the 14 strike. I paid $293 for it. So the max loss on this is going to be $293. If it expires worthless, that's my loss. It's capped at $293. If the price of the underlying goes down, then this put increases in value and I make money. Now, if we look at the stock, which is leg 2 of this, I ended up paying about $11.02, a couple cents more actually. But if we isolate a risk graph of just the stock, we have the following, which is this one here. So as the price of the underlying goes up, stock increases in value, and if the underlying goes down, then stock price will decrease in value. I'll lose money when it goes down, make money when it goes up. But imagine these two overlaid together. As the put, as the underlying goes down in price, the put gains in value and the stock loses value. So this is going to be a wash. So think of these two together, the sum being represented by a flat line, because as one gains, the other loses an equal amount. And this is at expiration, by the way. So I'm flatlined below prices of 14 for the underlying. Now let's look at prices of 14 and above. At 14 or above, the stock gains in value and the put does nothing. It doesn't gain or lose in value. So at prices at or below 14, we're flatlined, and at prices at or above 14, we increase in value. So the sum, the aggregate of those two is the following. I'm long the 14 put. I'm long 100 shares of the stock. So again, at prices 14 or below, I'm flatlined when the underlying goes down. And at 14 or above, this increases in value. So this is owning a put and owning the stock. In this case, is being synthetically long a call from 14. If we look at the trading platform, I have my fills here. Again, I bought the 14 put for $293, and then I piecemealed my way into the stock. I was looking to pay 11 or less, but I got a little impatient because I didn't want to waste a lot of time with this. It's a small position. Doesn't mean you can get sloppy, but I didn't want to spend a lot of time on it. There were some other things I was looking at. But anyway, I bought 25 at this price. I bought 50 at 11.04, and I bought the remainder. I wanted to buy a total of 100 shares, and I bought the remaining 25 at 11.06. So again, this is like the Excel sheet I showed you. At prices below $14, I cannot lose money now because of the decent prices I received or decent prices I paid on the stock. So I can't lose money if Rivn goes to zero, not a penny. However, if Rivn goes up, I'm synthetically long this 14 call, even though technically I don't have a call. I'm long a put and I'm long the stock, but that's equivalent to being long the call at 14. So as the price of Rivn, and this is a simulation price, as the price of Rivn increases, my P&L will increase dollar for dollar. So if it goes from 14 to 15, the position gains $100. If it goes from 15 to 16, the position gains another $100. And that's because I have a one lot. If I had 10, then it would increase by a factor of 10. Each dollar increase in price would be a $1,000 increase in P&L. And I still wouldn't lose any money because of the way the entire trade was constructed. Okay, I hope that was helpful. I'll catch you guys next time.